In this presentation, we will take a look at an example of closing entries related to the Internal Service Fund. As we go through this, remember that the Internal Service Fund is a type of proprietary type fund. When we think about the funds, we want to think about the grouping of funds. We have the governmental type funds, the proprietary type funds, the fiduciary type funds, the largest group being the governmental type funds, then using a modified accrual basis. We hear the proprietary type funds. They use a normal accrual basis. So we're in the Internal Service Fund using more of a normal type of accrual basis that most people are more familiar with from normal accounting in terms of for-profit type of accounting. The proprietary funds having the Internal Service Fund types, and then the Enterprise Fund types, Internal Service Fund types being those that service internal to the government. Keeping that in mind, we're going to go into the closing process. Here's going to be our trial balance before the closing process, it being in order, assets in green, liabilities in orange, then the light blue being what would be similar to the equity section in a for-profit type of organization, net position here. Dark blue is what would be the income statement type of accounts in for-profit type of organization, those accounts that are temporary, those accounts that would typically close out to the equity section in a for-profit organization, those that close out here to net position, and of course what we're working on at this point in time. What we're working on at this point in time, closing process, is to take these accounts, the dark blue accounts, just as we would in a for-profit type of organization, the ones at the bottom of a trial balance, the ones that would be similar to the income statement accounts, making them zero, closing them out to what would be similar to the equity section, in this case, the net position type section. So we're going to go through this transaction just like we would in a for-profit organization. Because we're on an accrual-based system, this is more of a straightforward process than it might be in some other types of accounts on a modified accrual, because we don't have to deal with things like budgetary accounts, which is nice. So we don't have the budgetary accounts, and the accounts that we are dealing with look more straightforward, such as expenses as opposed to expenditures. We'll record the closing process in more of a two-step type of process. We will use a clearing account. So the clearing account is going to be called excess of cost over net billings to departments. That's similar to an income summary account for a for-profit organization. So if you have a for-profit organization, we could close everything out with one type of transaction, just close out all the temporary accounts and take it to what would be for a for-profit organization, possibly retained earnings, possibly a capital account, depending on if we're a corporation, or possibly a sole proprietorship. Here, or we can do a multiple process system, closing out the revenue to something called an income summary account, a clearing account in a for-profit organization, closing out then the expenses to the income summary account, and then closing out the income summary to what would be equity or the capital account or the retained earnings account, and then we would have to deal with draws. Now, we don't have draws here because draws represents money taken out by the owner. We don't have the owner, so it's more simplified in that case. Instead of using the income summary as the clearing account, we're going to use this excess of cost over net billings. That just means that we're going to close everything out into it, and then we're going to close it out, and then put the balance where we want it to go, which is going to be the net position balance. Okay, so to do that, we're just going to take each of these numbers, and we're going to build our journal entry to do whatever we need to do to make these go down to zero. So this is a credit of $77,100. Therefore, we're going to debit it, $77,100. These are debits, all these expenses, of course. $58,400 is a debit. We're going to do the opposite and credit it. This is a debit, $4,010. We're going to do the opposite and credit it. This is a debit, $3,700. We're going to do the opposite and credit it. $14,610 debit. We're going to credit it. $8,180 debit. We're going to credit it. So our transaction then, we're going to say that the $77,100 is similar to revenue. We're going to make it go down with a debit, and then we're going to credit all of the expense accounts, just lining up exactly what is exactly in there, because we need to make them go down to zero. If we then take the debits minus the credits are winning by $18,800, and therefore we need a debit to make this thing balance out so that the debits equal the credits. And that is the amount that's going to be going to the excess of cost over net billings to departments, or the clearing account. If we record this out, then we're going to say that the $77,100 is here, bringing it down to zero. Here's the $58,400, bringing it down to zero. Here's the $4,010 and the $33,007, bringing them down to zero. And the $14,610, the $8,180, and the $7, of course, bringing those down to zero as well. the difference going to the clearing account at the 18,800. Here's the clearing account, it increasing in the debit direction, which of course means that we had a net loss. You'll see here the expenses are greater than, in essence, the income. So we have a net loss. Next step is going to be to take that amount. So we're going to pull these numbers over. Now we're going to do the second transaction. This is in the clearing account. Where do we want it to be? We want to be in the net position account. So we're going to make this 0 and we're going to move it just up here. So how do we do that? Well, this happens to be a debit now because it's kind of like a loss. We're going to do the opposite, credit it, and that means we're going to have to debit the net position. So we'll have the net position unrestricted debit for the 18,800. We'll credit the 18,800 in the excess of cost over net billings to departments or the clearing account. That'll take this number down to 0 as we would expect, and the net position account at 12,800, we're going to credit the 18,800. And that brings it at 6,000 on the debit side. Now, the next thing we're going to do is have this adjustment between these two accounts, the net position, net investment in capital assets, and the net position unrestricted. So we're going to adjust these two accounts. And I'm going to do this here. We're going to say that we've got the machinery and equipment and the related accumulated depreciation. That's going to be the investment in the capital assets. That is at 5,600 minus the 3,700. That's 15,900. So that 15,900, that's what we're going to say this net position, net investment in capital assets should be. It's at 22,900. So if we subtract this out, we're going to say minus the 22,900. That's going to be a $7,000 adjustment. So we're going to adjust this by 7,000 basically to match the investment in the capital assets. Now, why would we do this? Note that in essence, what we're doing is we're saying the net position in this account represents the assets minus the liabilities. So assets minus the liabilities gives us the net position. And that's usually the number that people are going to look at and say, well, we want to spend that money possibly, right? We got the assets minus liabilities. That's the net position. We want to commit that money possibly somewhere. Because this is on a normal accrual basis, however, this net position also reflects things that are going to be more of long-term assets as opposed to modified accrual like the other type of governmental funds. That means that some of this net position is being reflected on long-term assets, things that we cannot spend easily. Obviously, we can't spend something that if it's machinery and equipment. So we're basically going to break out down here in the net position and tell people, hey, look, this is something that you can't spend really because it's related to long-term assets that we can't sell in order to make any spending. It's not representing net cash that we're having here. These are representing long-term assets, and we want to represent that clearly in what would be similar to the equity section in the net position section. So we'll make this adjustment then. We're going to say we'll debit the net position, net investment in the capital assets. It was at 22,900. We debit it, bringing it down to the 15,900, and then we're going to credit the net position unrestricted, the other side. It was at 6,000 debit. We're going to credit it 7,000. It's now at 1,000 on the credit side. So in essence, if we were to go through this, we'd say, all right, the 5,600 minus the 3,700, the machinery and equipment minus the accumulated depreciation is the 15,900. And we could also say that the assets minus the liabilities, or we could say that the assets are at 1,460 plus the 5,400 plus the 490 plus the 5,600 minus the accumulated depreciation contra asset 3,600 minus the liabilities 2,550 minus the 2,630 minus the 1,170. That 16,900 equals the equity here. So, or what would be similar to equity, the net position. Net position is what people would typically look at and say, I'm going to try to spend that in the future possibly. What can we do with that money? So we're saying, hey, this 15,900 of it, you can't spend it because it's represented as a capital asset here. That's not something that we can spend. It's not cash. It's not cash over the liabilities that we can spend. So that's one of the reasons that we have that net position or that breakout between the two.